Investing can be extremely complicated. It can take years of studying markets and trends and learning specific tools and reading charts before you even begin to buy your first investment. It can involve doing due diligence and getting down payments for real estate, and also involve upkeep and personally getting involved with your real estate investment to make sure it is sound and that your customers are happy. It can also be pretty easy. In this video, I'm going to talk to you about easy, relatively passive types of investments, including mutual funds, index funds, ETFs, and REITs. Why they're freaking awesome, and why they also might not be the thing for you, and how to start getting invested with them if you want to, even if you have no money to start out. So stick around. Gently, tenderly, lovingly, press that like button for the YouTube algorithm, and let's dive right in. But before we get into all that madness, you're watching Finance Squared. I'm your wily host, Derek West, and on Finance Squared, we love to talk about everything that it takes to be successful in life, particularly financially. And that involves investing. And I, like you, wish there were an easy way to make money. Frankly, there is no such thing as an easy way to make money. Anyone who tells you otherwise is probably lying to you, or at least not being as truthful as they possibly could be. Even things like the lottery require you to have at least a little bit of money at first before you even have the chance, the very infinitesimally small chance at that, to make any money whatsoever. Like I mentioned before, the truth is there is no easy way to make money. But there are ways that make sense for your aptitudes and your capabilities, and your willingness to work. And frankly, while it's not easy, it's not as hard as you think. Even when it comes to making small fortunes, making large amounts of money, while hard, can be simplified if you have the right tools, the right attitudes, a little bit of patience, and a lot of work ethic. But you do need some money. As with my example of the lottery, every investment opportunity starts with you having a little bit of that guava of your own to invest with. No fortune has been made with $0 and 0 cents, invested sensibly at a modern return rate of 0%. So to get started with any investment, you need to make money, even if you're going to flip houses with zero money down. By the way, notice how many fewer people there are telling you how easy it is to make money flipping houses with zero money down. Mostly because the real estate market has recovered. But for other reasons, it's really not possible at all to flip money or to flip houses with zero money down. But even if you could, that means that the time that you're spending flipping houses is time that you're not spending doing something else, which may or may not be more lucrative, and which is in fact costing you money. But anyway, you have to realize one thing. Some money is better than no money. And if you're starting off with $0 and 0 cents to invest, then you have to begin somewhere to get that some money. And that somewhere starts with you. That's right, investing in yourself. Take a look in the mirror and ask yourself, what skills do I have? What am I good at doing? What do I like to do? If the answer to the first question is none, and the answer to the second question is nothing, then use the answer to the third question to guide you. Into what you should study to help you to have great answers to the first two questions. A little confusing? I tend to get into a little bit of word soup. Let me give you a brief example to help out. If you like movies or video games, two things that a lot of folks say are wastes of time, and in many ways they are, but they also happen to be great industries to make vast sums of money in. Well, now you know where you should start investing in your education. Now, depending on how old you are when you're watching this could start out as simple books or online articles or even YouTube videos on the topic. Chances are, if you're watching this video, you like personal finances, stocks, investments, things like that. And you're taking the time to learn more about all those things to better yourself in the future. Kudos on a wise decision. Like and subscribe. But now that you have something you're interested in, it's time to find something to go deep in on that subject. And how deep you go in on a subject can determine how much money you can make on that subject. And what path you go to get to the bottom of your subject at heart will depend mostly on your aptitudes, whether you're good at math or English. Now, you can go really deep and make a lot of money, even if you're not good at math. Don't let the STEM freaks tell you anything different. It's all about how much you can master the details. Or even if you're a big picture type of thinker, how big can you think? There's a million different ways to get the understanding you need to go deep. And that can include formal education. Maybe you're a bit older and you need to retool for a better job, or maybe you're younger and you're just starting out in the world. Formal education can be a great way to get the skill and credentials, if we're being honest, to be able to get work from people that need the work to be done. When I say formal education, I mean things like university classes and getting a degree and or a certificate, maybe a bachelor's, master's, postgraduate certificate, things like that. Those can be excellent ways to certify that you know what you're talking about and what you're doing, so that employers can hire you to do the things that you want to do to get that money that you need. But it doesn't have to be formal either. You can get online classes from lesson sites like Udemy or Skillshare or any other number of online sites that specialize in teaching skills to people that are looking to gain them. And they're mostly dirt cheap, much cheaper than what you would pay at a standard college. Now, to get wide and deep on a subject, it's time to put those skills that you've just learned to use. You've invested in yourself by getting an education. Now, you need to invest in yourself further by exercising those skills somehow, some way. At first, it's going to be hard, but like I said before, patience and a good work ethic will help in this greatly. What else is going to help with this? Perhaps think about putting your skills to use for free for a time. I know. A lot of people are fighting right now over whether or not minimum wage should be higher and things of that nature. That's not necessarily the subject of this channel, and there are good arguments on both sides. However, putting your skills to work for free is a great way to get actual real-world experience while at the same time upping your skills. You see, that's an exchange that a lot of people don't really take into account. You work to get real-world skills on your resume so that you can charge people for more money. Interesting trade-off, wouldn't you agree? There are sites that allow you to do this. Craigslist is one. Other sites that you can use to advertise for this would be Fiverr or Upwork. And you don't necessarily have to advertise you're working for free, but you can advertise that you're working for pretty cheap in order to gain the experience you need to start charging more money. Now, there are other more traditional ways out there as well. For example, internships, co-ops, working with family if they're involved in the same industry that you've just learned about, and just doing stuff as a hobby to try it out. And before you know it, you're making real money. And I'm not talking about minimum wage either. More than likely, it's not going to be Elon Musk level money either, but you're on your way. So now that you're making real money, you have to take part of that money and save it up in an emergency fund. You'll be so thankful that you did, trust me. When everyone else is panicking, when the market tanks, you'll be calm and collected and be able to make good decisions, knowing that you have some funds in reserve for when things hit the fan. I made a ton of money simply by not selling on the way down during the last market crash, but instead buying more. That's because of the confidence that I had that the markets would rebound quickly. And also because I have money stashed away for when stuff really hits the fan. I like saying stuff hitting the fan. Not sure why. But another thing you should be doing once you start making a little bit of money is you're going to want to use credit cards wisely. Using credit cards wisely is going to help you to get your credit score into the right place so that you'll be able to invest into more profitable investments in the future. I talk about all these things in other videos on my channel, by the way. So if you want in-depth discussion on all of these topics and more, take a look at some of the videos in the video cards above. They'll be great, I guarantee it. And definitely subscribe and click that notification bell because much more of the same is on the way. But now that we've laid the foundation for your wealth creation, it's time to really invest. And like I said at the beginning of this video, investing can be pretty complex. There's a lot to take into account and a lot you have to learn and do to be successful. And there's good reason for that. Like I mentioned, growing your money is not an easy thing to do. There's a lot of business and investments that go south, particularly during this pandemic season that we're all suffering through. There are also businesses and sectors that grow like crazy and then go bust immediately after that. So it takes a lot of time and a lot of research to separate the wheat from the chaff. And if you are like a lot of folks, you simply don't have that time, particularly if you're in the real world, executing on the skills that you worked so hard to gain. But just because something is hard doesn't mean it has to be complex. There are simple ways to invest your money. And among those ways are mutual funds, index funds, exchange traded funds, and real estate investment trusts. And they can help you steadily grow your income without you having to grow the amount of time you spend in deep research. They, of course, have their pluses and their minuses. For one thing, they're not as profitable, and you will not become rich overnight investing in any of those by any means. The fact of the matter is, it will take steady and consistent investment in each of those types of investments to grow your wealth over time. That's one of the many reasons why professional investors tend to stay away from them. But that dark cloud also has a silver lining. They're not as risky. You see, for reasons we're about to get into, they represent ways to diversify your portfolio almost automatically. And because of that, they tend to reduce downward pressure on people's portfolios that tend to cause such portfolios to go south when the market goes south. And each of them can be a great way to make extra cash while you put together your big plan. Let's talk about mutual funds first. Mutual funds are a type of investment made up of a pool of money. And this money is collected from many investors and to invest in securities like stocks, bonds, and other financial assets. You can think of mutual funds as actual companies that offer investors shares of themselves to buy into the investment. Now, these funds are operated by professional money managers who allocate the fund's assets and attempt to produce capital gains and even income for their investors. If you have a 401k or a pension through your employer, you more than likely have your retirement invested in a mutual fund. Now you, the investor in a mutual fund, can make money in 3 ways. From income earned from dividend on stocks and interest on bonds held in the fund's portfolio. Most mutual funds offer the investor the option to get a check from the distributions or to reinvest the earnings and grow their investments and nest egg even faster. Another way to get money from a mutual fund is as a distribution from the fund if the securities that fund has invested in have increased in price and have thus been sold. Finally, the third way to make money off of a mutual fund is if you sell your shares in the fund after it has increased in price. But notice how the fund manager is doing quite a bit of the work for you. All you have to do is put your money in, and then you get to watch the profits as they roll in. Now, there is a downside to mutual funds, namely the fees that you have to pay for the privilege of being in the mutual fund. That fund manager isn't free. he or she has to be compensated, and other costs associated to the fund need to be paid as well. And then there are index funds. Index funds are a type of mutual fund. Index funds are a type of mutual fund with a portfolio constructed to match or track the components of a financial market index. A common example is the Standard & Poor's or S&P 500 index. These are different than mutual funds in that there is not much money management happening with them. They simply represent a basket of stocks, balanced appropriately to match a certain index. They follow their benchmark index regardless of the state of the market or the index. They don't try to beat it. They don't try to make the losses less when it goes down. The upside to index funds is that because there is not much money management happening with them, you tend to have very low fees. When you buy an index fund, you're buying an automatically diverse investment without all the associated fees and complications of buying shares of individual stocks yourself. And also, when you buy into an index fund, while you are buying into a mutual fund, the fund manager is effectively doing less work. Therefore, the fees for that fund are much less than a standard mutual fund. And let's not forget, when the market, and particularly the index that your fund is tracking, when those things do well, you do well. But on the other side of that, when the market doesn't do well, you don't do well. The thing with mutual funds is that the money manager is always trying to get as much profit for their investors as possible. Or when the market goes down and down and down, much like it did in early 2020. The fund manager tries to keep the losses as small as possible for their investors. With index funds, you don't get that level of service. They simply follow the market, and that can mean following them off of a cliff. And that's where having your emergency fund comes in. If you stay calm and don't panic, and you understand your investment horizon, that is the time you will stay invested until you retire. And like I mentioned and I keep mentioning, you don't panic, and you don't panic sell when everyone else is panic selling. And perhaps you're even doubling down and buying more. Then typically the market goes right back to where it used to be, and thus your index fund tends to go back to right where it used to be. Now the time frame for that can be long, as in the Great Depression, or it can be shortish, like during the panic that happened in March and April of 2020. No, but speaking of market-based investments, there's also ETFs. An ETF, like an index fund, is a type of security that involves a collection of securities, such as stocks that track an underlying index. The thing that differentiates ETFs from both mutual funds and index funds is that they are listed on various security exchanges, thus the exchange in the title of the security. And they are traded throughout the day, just like stocks, bonds, or other instruments that they are based on. Do you have an investment strategy you're looking to try out? There's an ETF for that. Want to focus on safer investments like bonds? There's an ETF for that. Want to focus on green energy? There's an ETF for that. Want to focus on the fossil fuel economy? There is an ETF for that. Want to focus on commodities? There's an ETF for that. Want to focus on advanced investing strategies like shorting stocks? Yep, you guessed it. There's an ETF for that. Now the downside to ETFs are that because they can be traded during the day, just like stocks, they tend to also have volatility levels, similar to stocks. When the market goes well, people tend to stampede out of their investments rather than taking a measured, reasonable approach. So that can cause the value of ETFs to rise and fall quickly and sharply, just like the instruments that they're backing. And then there are REITs, or real estate investment trusts. Do you want to invest in real estate? Do you hate unclogging other people's toilets or fixing their broken water heaters and furnaces? If you answered yes to both of those questions, then REITs might be what you're looking for. Now, Real Estate Investment Trust is a company that owns, operates, or finances income generated in real estate. They are modeled to operate in the way that mutual funds pool capital of numerous investors. In other words, they're effectively companies that offer stocks or shares of themselves and sell them on the open market, making it possible for investors to earn dividend from real estate investments without having to buy, manage, in other words, unclog toilets, or finance that real estate property themselves. Now, REITs generate a steady income stream for investors, but they typically don't offer a ton of capital appreciation the way that traditional real estate investing does. REITs can be and are traded just like stocks, meaning they are highly liquid assets, but also meaning that they can suffer from similar volatility issues. So what's next? Take a look at some of the videos on the screen to get even more familiar with exotic investment instruments and also regular investment instruments. And be sure to subscribe and click that notification bell because we have more videos on this topic and on breaking down strategies for each of those types of investments and many others, including the best ways to invest in cryptocurrency, coming up in the very near future. So be sure to like this video if you like this video. And always remember, a goal without a plan is a wish, and a goal with a plan and no action is a wish list. Take action on your personal finances by taking your hard-earned money and looking into investing into index funds, mutual funds, ETFs, or REITs if they suit your investing preferences. And I'll talk to you guys later. Peace.